This video is intended to accompany the notes in Intermediate Accounting 1 class from Chapter 7, Cash and Receivables. We talked first about cash and equivalents, and then accounts receivable, and then notes receivable. Cash includes coin, currency, checking account balances, a few other odds and ends. The cash balance shown on the balance sheet is the amount the company has available to spend, with a few exceptions. First of all is what we call restricted cash. Restricted cash includes compensating balances, which are reported as long-term investments. Compensating balances would be an amount that a company is required to keep in its cash account as part of maybe a borrowing arrangement with a bank. Overdraft balances, that is negative balances in the cash account, are reclassified as short-term liabilities when it comes time to produce financial statements. And cash equivalents are short-term investments with a maturity of less than 90 days at the time of purchase. Other short-term investments would typically be classified under current assets as short-term investments or marketable securities. Like individuals, businesses hold cash for various reasons. First of all, transactions purpose, that is to be able to actually pay your bills, to do business. Emergency purposes, meaning that you've got adequate funds to be able to, let's say, avoid the risk of running out, being able to pay unexpected bills as they come due. And speculative purposes, which is really the flip side, maybe the more positive side of the emergency purposes. That is where an opportunity arises, and if you've got liquidity, you can take advantage of it. Whereas if you didn't have that, you'd have to pass it by. As with most current assets, you want enough, but not too much, so that a company has to weigh the costs and benefits of holding too much or too little. This could actually be said of just about any asset, but particularly inventory. You think about, you want to have enough in order to be able to conduct business and not disappoint customers and be ready maybe for even unexpected demands on your products. On the other hand, keeping inventory on hand is costly. You have to pay for space to keep it, places to store it. You have to insure it, and of course you risk obsolescence and damage the more inventory you have, and so there's always some trade-offs between having enough but not too much. We talk here about cash and internal control. Cash is one of an interesting asset because it's the easiest one to steal, in a sense. That once you have someone else's cash, they're not able to very often able to determine that it was in fact their cash. Administrative controls ensure efficient cash management. Companies, for instance, might use what we call sweep accounts in order to sweep excess funds in a non-interest-bearing account into an interest-bearing account in order to make better use of those funds. Administrative controls will determine, for instance, how much cash you need to have on hand so that you don't have excess amounts sitting around. Cash is typically a non-earning or a low-earning asset. So you need to have enough but not too much. Internal accounting controls ensure protection of the asset and the correctness of your cash records. A number of controls exist to safeguard and monitor the management of cash. One essential safeguard relates to what's called the separation or segregation of duties, which involves assigning responsibilities such that one person who has physical access to cash does not also have access to the accounting records, such that that person or someone may take cash and then cover it up in the theft of the records. And so you want those duties to be separated so that someone can't take cash and then cover it up through control of the records. Petty cash is usually established as an imprest fund. Now, petty cash is typically used in order to pay small bills because processing a check involves delays, but it also involves administrative time and effort. And so very often in a business you will have a petty cash fund. But the fact that it's called an imprest fund means that a balance is set at a limited amount that's been pre-authorized. As expenses are paid from the fund, receipts replace the cash. Periodically, the fund is replenished in an entry by which cash is credited and the appropriate expense accounts are debited. For example, let's say that we want to establish a petty cash fund in a business. And so we believe that $200 is plenty for that, so that if certain events arise, let's say you're going to have a small lunch or something, you need certain paper supplies, or you want to buy food for that, then instead of having to write a check or have someone use their own funds and then get reimbursed, we have a petty cash fund. The petty cash fund is set at $200 in this case. And so the way to actually initiate that fund is we would transfer essentially funds from petty cash, from the cash account, to checking account, to petty cash. So debit petty cash and credit cash. Now you actually would have someone, a petty cashier, who is responsible for that money. And so they would be as the cashier, would have that money in their possession and would need to be very careful about allowing other people access to it. So we're actually writing a check to the petty cashier for $200. That person then cashes that check and then puts it in some safe place, like a small box where they can keep control of it. So the petty cash fund is then established in that way. Let's say that over the next few weeks, expenses paid from the fund include office supplies for $38, postage of $26, and advertising expenses of $50. I'm thinking of a situation where this really happens, where you've got a group from a local school that comes into the business, and they want the business to donate $50 for a spot in a football program, for instance. And so it's a lot easier just to handle those things in this way, or this is the way it was handled. But that represents an expense of the business. Technically, it's advertising. So this means that the petty cash box contains receipts for those items. In other words, the petty cashier paid those expenses out of the box and maintained a receipt. So after these events, or after these particular disbursements had been made, then the petty cash box contains receipts for these items totaling $114, and of course, therefore, you should have the remaining petty cash, $86, still in the box. Now, to replenish that fund, here's the entry that would be made. We would have to write another check. That's what's important. Check to the petty cashier, just like we did when we established the fund. In this case, for $114, the total of those disbursements that had been made. Notice, of course, we have to charge those expenses for the correct amounts, the supplies, postage, and advertising, so that we've got, of course, have recorded those amounts for the correct use. If the amount in the petty cash box doesn't equal $200, for instance, let's say we have a check, we have a surprise audit where the petty cashier is approached by someone in the administration who's been authorized to do this, very often someone from the accounting department, and says, okay, I need to do an audit of the petty cash. And let's say they open up that box, and that the amount in the petty cash box, that is the sum of the receipts and the remaining cash, are not $200. Let's say it's $195. Then $5 is missing, and a cash short and over account would be used to make the necessary adjustment. Cash short and over is more or less a plug type of figure, if it in fact is a debit, because in this case you would have to charge an expense account, cash short and over, and credit cash, in order to show that that short